Welcome back to the deep dive. Today, we're building on something we talk about a lot here, risk transfer.
Right, that idea of shifting potential financial burdens.
Exactly. It's just such a cornerstone of smart financial strategy. And when you think about the biggest financial unknown, the impact of someone passing away,
Especially on their dependents.
life insurance really stands out. It's arguably the most direct way, the most powerful tool for that kind of risk transfer.
Absolutely.
So our mission today is to really unpack how it works, maybe demystify the different types,
Yeah, cut through some of the jargon.
and hopefully give you the insights you need to think about this for your own planning. But before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures. All the content, the examples, everything we discuss comes from the accounting resources over at farhatlectures.com.
Great stuff over there.
Yeah, so whether you're an accounting student, maybe studying for the CPA, or even a professional, definitely check out the website. They've got extra practice questions, video lectures, lots of support for today's topic.
Really helps reinforce the learning.
Absolutely. And special thanks to Professor Farhat for providing all this valuable material.
Okay.
So let's get right to it. The big question. What is life insurance, really, at its core? People talk about the death benefit, but it feels like there's more to it.
You're right, there is. Fundamentally, it's a contract, a financial contract designed to soften the blow of, well, mortality risk.
Mortality risk sounds a bit clinical.
It does, but it just means the financial consequences of someone dying maybe sooner than expected.
Yeah.
It's about making sure that if, the unthinkable happens, if you're not around anymore, your dependents, your family, they aren't suddenly facing a financial crisis on top of everything else.
So practically speaking, what does that support look like?
Well, it's really direct support. Covering funeral costs, yes, but usually much more than that. Think about paying off the mortgage so the family can stay in the home.
Right. Big one.
Or other major debts. Car loans, credit cards,
Yeah.
and then there's future stuff, like college education for the kids.
Yeah. Huge expenses.
Exactly. It basically provides that income replacement, that cash flow to keep things stable. It stops a personal tragedy from becoming a financial catastrophe.
That's huge. That peace of mind must be invaluable.
It really is. But what's interesting is how people approach it. Some really underestimate how much cover they actually need.
Leaving gaps.
Right. While others might maybe overspend on policies that aren't quite the right fit for their actual goals. It's a common issue.
Finding that balance, which brings up cost. It seems daunting for some. Is there like a way to figure out affordability?
That's a really important point, and it often starts with this concept of insurability.
Insurability, okay.
Yeah, before you even talk price or policy types, the insurance company needs to decide if you actually qualify for insurance.
You mean not everyone can get it?
Not everyone, no. Or sometimes the cost might be so high it just doesn't make sense. It depends on their assessment of your risk.
Okay, so how do they figure that out? What makes someone insurable?
It's a process called underwriting. They look at several factors. Your age is a big one, obviously. Your current health status.
Makes sense.
And your lifestyle. Things like, do you smoke? How much alcohol do you consume? Even your driving record can play a role.
Wow, driving record.
Yeah, because it all feeds into their calculation of your mortality risk, how likely you are statistically to pass away sooner rather than later.
So two people, same age, same policy amount, could pay very different prices.
Oh, absolutely. Dramatically different. You could have someone getting, say, $1 million policy for maybe $2,000 a year.
Okay.
And someone else, same age, same $1 million, might be quoted $15,000 a year.
15,000, just based on health and lifestyle.
Primarily, yes. The underwriting involves looking at your medical history, maybe going back 10 years, hospital visits, medications.
We really dig deep.
They do. Blood tests, blood pressure checks, sometimes even a quick health checkup at your home by a paramedic.
Feels a bit invasive.
It can feel that way, but that thoroughness is actually what helps keep premiums fair overall. Lower risk people generally pay less.
Right, okay. That makes sense. So assuming you get through that, you're insurable. What's next? You mentioned different types. Can you customize them?
You definitely can.
Yeah.
And that's where it gets really interesting. Once you have a basic policy structure, you can often add things called life insurance riders.
Riders, like extras.
Exactly. They're optional add-ons that enhance the policy. For example, there's something called an accelerated death benefit rider.
What's that?
It lets you access some of your death benefit while you're still alive if you're diagnosed with a terminal illness. Helps cover medical bills or other expenses.
Wow, okay.
Or a waiver of premium rider. If you become totally disabled and can't work, this rider means the insurance company pays your premiums for you, so your coverage stays active.
So you can really tailor it.
Yeah, add layers of protection for specific situations that might worry you.
Okay, so we know the purpose, we know about getting insured, customization. Let's talk about those main types. I often hear term and whole life. Let's start with term. You called it the rental option earlier.
Yeah, that's a pretty good analogy. Term life insurance is temporary. It covers you for a specific period, the term.
Like 10 years, 20 years?
Exactly. Common terms are 5, 10, 15, 20, even 30 years. You pick the term, you agree to pay the premium. Usually it's a fixed premium for that whole time.
Okay.
And if you pass away during that term, your beneficiaries get the payout, the death benefit.
Simple enough. What are the key things to know about it?
Well, first, it's generally the most affordable option. You can get a lot of coverage for a relatively low premium, especially when you're younger and healthier.
Lower cost, big benefit. Sounds good.
It is. But the second key thing is crucial. It does not build any cash value.
Ah, okay. So like the rental car analogy.
Exactly. You use it for the trip, for the period you need it. When the term is up, if you're still alive, the policy just ends, expires. You get nothing back.
And if you still need insurance then?
You'd have to apply for a new policy or maybe renew the old one if that's an option. But because you're older now,
The price goes up.
almost certainly yes.
Yeah.
Your mortality risk is higher just because of age, so the premium will reflect that.
Okay, so term seems really efficient for specific temporary needs. When does it make the most sense?
It's perfect for covering responsibilities that have a clear end date. Like you mentioned earlier, a mortgage. Maybe you have a 30-year mortgage. A 30-year term policy ensures that if something happens to you, the house gets paid off. Or raising kids, you might want coverage until they finish college and are financially independent.
So covering those big time-limited obligations.
Precisely. Once the mortgage is paid or the kids are launched, maybe you don't need that same level of coverage anymore. And because it's cost-effective, it's great for people, just starting out, families with tighter budgets who still need significant protection.
Makes a lot of sense for those defined periods. But what about long-term security? Lifelong needs. That brings us to the other side, right? Permanent life insurance. The owning a home analogy.
Exactly. This is a fundamentally different beast. Permanent life insurance and whole life is a common type of permanent insurance.
Okay.
It's designed to provide coverage for your entire life. As long as you pay the premiums, the policy stays in force.
The whole life. Got it.
But the really big difference, the owning part of the analogy, is that it includes an investment component. It builds cash value over time.
Okay, cash value. How does that actually work?
Well, part of your premium payment covers the cost of the insurance itself, the death benefit protection. But another part goes into this cash value account. The insurance company invests that money. Usually pretty conservatively bonds, maybe some stocks.
So it grows.
It grows, yes, usually on a tax-deferred basis, which we'll get to. Now, the growth might be more modest than, say, investing aggressively yourself in the market.
Sure.
But it's generally stable, and it comes with guarantees. And over many years, this cash value can really add up.
To the point.
To the point where the dividends or interest earned on that cash value might become large enough to actually help pay the policy premiums, or even cover them entirely.
So the policy could eventually pay for itself.
Potentially, yes.
Yeah.
It depends on the policy's performance and how long you hold it. But it's a key feature. It can become self-sustaining.
That's fascinating. And this cash value,
Yeah.
it's not just sitting there until you pass away, right? Can you access it?
Yes, absolutely. That's another major benefit. You can typically borrow against the cash value.
Like a loan.
Exactly. It's similar to taking out a home equity loan. The cash value acts as collateral. So if you have a policy with significant cash value, you could potentially borrow against it for, emergencies, opportunities, whatever you need.
Without necessarily cashing in the whole policy.
Right. The policy stays in force, though the loan balance plus interest would be deducted from the death benefit if you passed away before repaying it.
Okay. And you mentioned tax benefits earlier. That sounds important.
Hugely important. Permanent life insurance comes with some significant tax advantages. First, that cash value growth we talked about, it grows tax deferred, meaning
Right.
you don't pay income tax on the gains each year as it grows.
Yeah.
Taxes are deferred until you potentially make withdrawals that exceed what you paid in premiums.
Okay. Deferral. What else?
Dividends paid by many whole life policies. Generally tax-free, they're often considered a return of your premium.
Tax-free dividends. Nice.
And the biggest one for many, the death benefit paid out to your beneficiaries is almost always completely income tax-free.
That's huge. So the full amount goes to the family.
Exactly.
Yeah.
Which makes it a really powerful tool for estate planning, especially for people with larger estates who might face estate taxes. The life insurance proceeds can provide immediate tax-free cash to cover those taxes.
So heirs don't have to sell assets.
Precisely. Keeps the estate intact. Just one clarification, though. The premiums you pay for the policy, those are generally not tax deductible.
Right, you mentioned that. Okay, so lifelong coverage, cash value growth, potential self-funding, access via loans, major tax benefits. Seems like a lot of advantages. What's the downside? There has to be one.
You guessed it. The main downside, or trade-off, is the cost.
Ah, more expensive than term.
Significantly more expensive, yes.
Yeah.
Especially in the early years. Because you're paying for both the lifelong death benefit and funding that cash value component, the premiums are substantially higher than for a comparable amount of term insurance.
So it's a bigger commitment up front.
It is. Which is why, as you said, some people might start with term when their budget is tighter, maybe when they're younger. And then later, as their income grows, they might convert that term policy to permanent or buy a separate permanent policy to get those long-term benefits and cash value accumulation.
That makes sense. Start affordable, then build up. Okay, that really clarifies the two main paths. Let's try and lock this in with an example. You mentioned the source material. Farhat lectures. Let's use one of their questions, maybe focusing on those tax benefits we just discussed.
Sounds good. A practical application.
Okay, here's the question. Which of the following is a tax benefit of a permanent life insurance? And the options are: A, dividends are always subject to immediate taxation. B, withdrawals are always tax-free. C, accumulated value grows on a tax-deferred basis. D, premium payments are tax-deductible.
Okay, let's break it down. Option D. Premium payments are tax deductible.
We just covered that one.
Right. Generally, no. Life insurance premiums aren't deductible for individuals. So D is incorrect.
Got it. D is out. What about A?
Option A. Dividends are always subject to immediate taxation. That word always is tricky. As we said, dividends from these policies are usually treated as a return of premium up to the amount you paid in. So they're typically tax-free, not immediately taxed. So A is incorrect.
Okay, A is out. Next, B.
Option B. Withdrawals are always tax-free. Again, that always is the key.
Red flag word.
Definitely. While you can access cash value through tax-free loans, direct withdrawals can become taxable. If you withdraw more than your cost basis, basically, more than the total premiums you've paid, that excess can be taxed as income. So not always tax-free. B is incorrect.
So that leaves...
That leaves C. Accumulated value grows on a tax-deferred basis.
And that sounds right based on what we said.
It is correct. The growth inside the policy, the interest and gains on the cash value, isn't taxed year by year. The tax is deferred. That's a major advantage for long-term accumulation. So C is the answer.
Excellent breakdown. Really shows how important those specific terms are deferred versus free, always versus sometimes. Okay, so wrapping this up. We've really dug into life insurance today. Its core job is risk transfer. We looked at term life, the rental car, affordable, temporary, great for specific needs like a mortgage or raising kids.
Right, pure protection for a set time.
And then permanent or whole life, the owning a home approach. Lifelong coverage, building that cash value, investment growth, tax benefits. More complex, more expensive, but built for the long haul and wealth accumulation.
And really understanding those fundamental differences, that's the key, isn't it? It lets you make a choice that actually fits your life, your budget, your long-term goals. It's not about just buying a policy.
No.
It's about building the right kind of financial safety net for you and the people you care about. Getting that peace of mind. Applying the knowledge is where the real value is.
Well said. And it makes you think, beyond just term versus permanent, how else could you tailor this? We didn't really dig into it, but what about something like laddering multiple term policies? Buying maybe a 10-year, a 20-year, and a 30-year policy.
Right, so your coverage amount steps down as your needs decrease, like kids leaving home or the mortgage getting smaller.
Exactly. How might thinking about strategies like that change your perspective on protecting your family and building that financial plan? Something to mull over.
Definitely food for thought.
And if you do want to explore these ideas more, remember, farhatlectures.com. Tons of resources, practice questions, videos. Really helpful for cementing this stuff.
Great place to go deeper.
Absolutely. Well, thanks for diving deep with us today.